祖国一直牵挂着香港、澳门的繁荣稳定。
Although China is borrowing more money, the rate at which its businesses are borrowing is what should really worry us. The ratio of non-financial sector debt to GDP has increased dramatically since 2008. Officially, there are about 1.5 trillion yuan worth of non-performing loans at China's commercial banks. At the most recent assessment, debt of all kinds across all economic sectors amounted to the equivalent of $51.9 trillion. That's about 3 times the size of the Chinese economy. How did China transition from being the engine of global economic growth to a nation burdened by debt several times its size? And most importantly, how would the collapse of the Chinese economy affect the whole world? Join us as we discuss the debt crisis of the Chinese economy. The amount of debt that China is carrying is significantly more than that of the US. The United States' total debt as a percentage of GDP surpassed China as recently as 2020. However, China had a relative debt load that was 40% more than America's as of mid-2022. Since Beijing started keeping track of these numbers 27 years ago, this is the largest degree that has ever been observed. The situation seems destined to worsen. According to the National Institution for Finance and Development, which is supported by Beijing, local governments plan to issue additional debt worth about 4 trillion yen or $571 billion next year. One thing to note is that when the Chinese central planners start a spending program, like the most recent plan to develop infrastructure, they require local governments to issue the debt required to fund the initiative. Through the middle of 2022, the most recent time period for which data are available, the debt has increased by 11%, a rate that is quick enough to more than offset slight cutbacks in private borrowing caused by the uncertain economic future. According to analysts, currently 2/3 of corporate debt is held by China's colossal state-owned companies, many of which are ineffective and unprofitable. However, some analysts claim that because lenders employ a number of strategies to hide the actual amount, the bad debt may actually be 14 times larger. In fact, a significant government cleanup of bad debt at state-controlled banks resulted in a more than 50% decrease in the level of bad loans across the board. That's how the bad debt situation is in China. China has been moving in an unprecedented pace in becoming the fastest growing economy in the world, but all that has come at a price. And the debt to GDP ratio is quickly becoming unsustainable, hanging on a knife's edge. The high-speed rail system in China served as the country's infrastructure development's focal point, the crowning achievement of its building frenzy, and a visible demonstration to the rest of the world. Although the system is clearly excellent, it also poses a huge threat to the Chinese economy. So how did China build such a massive high-speed railway network so fast? Why did it build such a massive network? And finally, how much did it really cost to put all of this together? There are many people living in China, which is a very big country. Because of this, the government needed a strong rail network to give citizens an affordable and efficient means of transportation. But due to the fact that most Chinese workers would live and die in the city where they were born, and because there was little need for a nationwide rail system, this necessity was largely disregarded for a very long period. In the early 2000s, everything changed. The country's plan to open up to the world was already well underway at this point. Young people were migrating from their tiny hometowns to big cities in order to supply the labor required to support the country's expanding industrial sector. Even still, most of these workers couldn't afford to go by plane or drive their own cars to visit their relatives. Prior to the introduction of high-speed rail, the majority of workers were content to take bus trips, which would frequently take days or even weeks to travel comparatively small distances. The Chinese government had already begun to establish several high-speed rail systems by 2008, but the global financial crisis, or GFC, made the decline even more severe. China was not exempt from the effects of the GFC. In fact, it was far more dependent on trade at the time than it is now, and trade intensity dropped dramatically during this time. So China avoided entering a recession in significant part as a result of this high-speed rail expansion. Totally brilliant. Mission accomplished. China avoided a recession and benefited from it by building a high-speed rail system that allowed workers to move freely around the nation, raising living standards and expanding industrial capacity. But that was only dressing a wound when the limb should be amputated. The government's response was to sell the railways to the state-owned company China Railway, thus semi-privatizing them. A year later, CSR and CNR, the two businesses in charge of building the rail cars, united to establish the CRRC. These corporations had more discretion over how much money they could raise because they were legally separated from the government. Chinese railways had roughly $1 trillion in debt, which they paid off using a combination of investments from local governments, bonds issued by publicly traded companies, and loans from state-owned banks. On this most recent building push, issues arose almost immediately after the last rail was installed. You see, most of the extremely profitable lines between key population centers had already been created when China Rail began its most recent building spree. This means that the new lines that were being built wouldn't require as many trains and consequently wouldn't generate as much money from ticket sales. But even though they weren't particularly profitable, because they wanted people to have access to and from these lower-tier cities. They did this for a number of reasons, most of which were political. But aside from misguided political objectives, there were other issues as well. China's high-speed rail system became such a source of national pride that its creators never really paused to consider whether there may be a more effective way to move people throughout the nation. But you know what they say, if you hold the hammer, everything looks like a nail. The head of China Railways seemed to think every transport issue requires a high-speed train solution. The Chinese government certainly enjoys the attention that high-speed rail receives from the world community and its amazing technical capabilities. But there are occasionally better choices, like a regular rail. Yes, regular rail is far less expensive to construct and run, which also implies that tickets are significantly less expensive. Regular rail also has the advantage of being able to transport freight, which is very important for a nation as dependent on heavy industry as China. For a while and in isolation, China's high-speed rail network was an overkill. Highly sophisticated, but making little in profits. Losses on underperforming routes were offset by profits from highly successful ones. But the state-owned corporation still managed to turn a small profit even after paying off its enormous debt. Unfortunately, this delicate equilibrium finally collapsed in 2015, and the interest payments on the collected loans have been rising faster than the rail line's operating income. This has gotten worse for a number of reasons, including the line's aging and increasing maintenance needs. The rail line's inability to raise their prices because passengers would simply choose to fly or return to buses, and the arrival of COVID, which slashed the demand for rail tickets to the point where nearly every line was no longer profitable. The debt may also reflect a fundamental aspect of communist economic planning on a more fundamental level, and China's emphasis on centralized direction dominated by state-owned businesses tends to channel economic resources into a select number of expansive initiatives, in contrast to a largely market-based system where various actors pursue a wide variety of investments, dreams, and opportunities. Recent failures in real estate development are indicative. Although private companies are involved, the size of the failures nonetheless reflects the significant importance that central planners previously placed on residential construction. In fact, the sector represented an oversized 30% of the economy at its peak. China may have now reversed course, but the debt still exists and cannot be supported by the unsuccessful developments. Real estate isn't the only error either. The debt overhang that is now so obvious in the data was made worse by more mistakes of this kind. Another huge problem for China is the dropping birth rate. The Chinese population overall is aging. This is not a good sign. China already lacks young workers to sustain a disproportionately large senior population due to Beijing's decades-long one-child policy, which will only get worse in the years to come. According to a Pew Research Center assessment, China's population has already started to drop, and soon there won't be more than 3 individuals of working age for every retiree in the country's economy. These 3 workers will not be able to generate the necessary surplus. Therefore, Beijing will be forced to borrow money to meet its debt obligations for social security pensions. Hear that? More debt. The Chinese economic model would need a thorough revision to course correct from its impending doom. Thanks for watching this video. Don't forget to like, share, and subscribe to our channel so you stay updated on the unfolding stories in the world around us. See you next time.